So, hey guys, thanks for joining today. So, today we are going to learn about some economics concepts. Okay, some of the macroeconomics. These are. I'll really tell you that these are certain concepts that I always get confused with. Okay, because I always have to look for these concepts to get. It means every once in a while to get the clarity. Okay, so these economics concepts are needed because these are the ones that affect our economy, okay, in the short term, in the long term, in every way. These are the ones that affect our economy. Okay, so I thought while we are giving these classes, it is important to know about these things also before going ahead. Okay, so mostly we'll be studying about repo rates, bonds, and credits. Okay, repo rates, I'll tell you after some time. I'll tell you what it is, and that's all two things also. Meanwhile, I'll be referring to certain things. Okay, there's an Instagram channel Instagram handle that we have called Freenet. Okay, you can go to this, and whatever I'll be telling you are written in these two of the posts. Okay, banks part one and banks part two. Okay, so if you really like what we are saying, then just go and give a like to this post. Okay, now here are certain things that I'll be referring to, and I'll be giving the links in the description to for anyone to read these articles later on. But yeah, let's start doing without taking more time. Okay. So the first concept that we're going to is focus on is repo rate. Okay, repo rates. Okay. Now you must be wondering what is it. Okay. So suppose there are Indian banks. Okay. There is HDFC Bank. There is SBI. There is Kotak Mahindra Bank. These are all Indian banks. Okay, so these are all Indian banks, and let's take ICICI also. ICICI. Okay, these are all Indian banks. Okay, but there is a bank that is the bank of banks. Okay, that is called the central bank. Every country has a central bank. Okay, I don't know about every country, but most countries have a central bank. Okay, which you can say is the bank of banks. Okay, these banks park their money here. These banks deposit their money here. These bank, if they need loans, they take money from this central bank also. And all the bank, in case of India, it is RBI. In case of America, it is Federal Bank, and things like that. Okay, so these central banks are the ones who lay down the foundation for all the banks. Okay, means what kind of rules they need to have, what can and they're all means how much interest that they are going to give. Okay, they give the licenses to the banks to do whatever things they want. Okay, so this bank is kind of acts as a regulatory body for all the banks. Okay, and it also acts as a bank for these banks. Okay, just like I said, th- these banks deposit money here and they take loans from here also. Okay, so let's take a scenario. Okay, suppose uh, recent times we saw COVID. Okay, COVID. Okay, just ignore the handwriting. Anyway, so what happened was, nowadays you must be seeing that a lot of people are saying there is a lot of inflation and near a recession time is going to come and everything like that. The slowdown in economy is going to come. Okay, so what actually happens was in COVID times. Okay, COVID happened in 2020. The major hit came in March 2020. Okay, it started in March and it came to April, it went through May, it went to June, and it went to like this till September or October. It was a major wave. Okay, so what happened during these times? A lot of outdoor activities was not work, not working properly. Okay, many things were restricted. Okay, there was no proper outdoor activities, which affected the transportation. Okay, transportation, manufacturing got affected. Okay, uh, and people were not going out. People were not using the vehicles. So the businesses like road transportation, bus business, okay, airline business, and everything got affected. Okay, and transportation is a very key thing for the economy. Okay, if there is no proper transportation, economy doesn't grow properly. Okay, and since people were not coming, the manufacturing stopped, the transportation stopped. So kind of there sorry, so kind of there was a void. Okay, like they there was not much money coming into the economy out of the businesses. Okay, only those businesses which were running on online or indoor businesses, they were the ones, means, which did not involve much people engagement. They were the ones that were going good. Okay, so there, since businesses, a lot of businesses had stopped, a lot of money from the economy was going out. Okay, so in that case, what happened, this, since we are in India, we'll take the case of RBI, okay? But it happens in all the economies, okay? All the central banks do it, okay? What happened was has the RBI or central bank has the power to print more money, okay? Print print money, okay? It has the power to print money, okay? So the what will happen? Suppose we have a total of 100 crore rupees in the economy, and over the month period, RBI prints 10 crore more. Not, let's not say RBI, let's say central bank. Okay, they print 10 crore more. Okay, so a total of 110 crore of money comes into the economy. Okay, so this has some advantages and disadvantages. In short term, it always has advantages, but in the long term, it always has disadvantages. Okay, what happens in short term is the supply of money in economy increases. Okay, because of the printing of more money, since 10 crore more was available, so 10% supply of money increased in the economy. Okay, so the entire economy, the people overall had 10% more money, so they could buy more things. Okay, and since many people had lost their jobs, so if they had 10% more money, they will be able to buy 10% more things. Okay, means they will be able to support it in the people properly in that case. Okay, but since but what happens in a long term, since there is more amount of money available. Okay, so suppose this dollar. Okay, let's take dollar. Okay, let's take dollar. I'll tell you two scenarios. Okay, one is, since there is more rupee available. Earlier, what happens? Suppose $100 million are there. $100 million were there in the entire world economy, and 100 crore rupees were there in Indian economy. Okay, so uh, 1 crore rupee was equivalent to $1 million. Okay, in our economy. But again, since our government printed 10% more, now 11 crore rupee were equivalent to $1 million. Okay, so you see what 10 crore rupee could buy earlier for that was available for $1 million. Now we needed 100 crore rupee to buy things for $1 million. So what happened? The value of rupee decreased. Okay, the value of rupee decreased here. Okay, so this is one way. When a government or a central bank prints a lot of money in a country, okay, while the other countries do not print the money same time, okay, while the other currencies are stable, then the value of that currency in the international market decreases. Okay, decreases by a lot. This same thing happened in European markets. Okay, you must have heard about the great economic depression. If you have read in class ninth the uh, history of Europe, okay, if you're from CBSE background and class 9 you have read about history of Europe, you must have read that there was a great economic depression in 1929. Okay, what happened was, in Europe there was, especially in Germany, okay, especially in Germany, there was not much money to do anything. Okay, so what happened? The government printed a lot of money, a hell lot of money. Okay, without It means they blindly printed a lot of money. Okay, so that what that did, that decreased the value of that currency in the international markets. One. Second, what it did was, I'll tell you one more thing. See, second, what it did was what we see. Okay, here, when people have 10% more money, okay, 10% more money. So what they will do, since they have more money now and they see other people have more money to spend, they will start raising their costs. Okay, the businesses will start raising their costs, the service companies will start raising their costs. Okay, so in that way what happens, what 100, but it happens in a little longer term. Okay, it doesn't happen suddenly, it happens in a little longer term. So what happens, what 100 rupee could buy earlier, now it is costing 110 rupees. Okay, this printing of money is sometime later, it is costing 110 rupees. So what happened, this also decreased the value of currency. One was this international market thing, second was this internal thing inside the country. This also reduced the value of currency. So the same thing happened in 1929. Printing a lot of money by the government decreased its value in international markets also. Secondly, internally within the country, the prices of food rose a lot. Okay, since there was a lot of money and many people did not have money. Okay, what happened was there was a lot of money printed out. Okay, but then also many people did not have money. So what they did, they started charging more. Okay, this was a very complex scenario, we cannot explain it with these simple things, but this is what, many things like this happened. Okay, this, and they printed a lot of money and many people start charging a lot of money, and then the breads were also available at a very much high cost. Okay, like thousands of dollars it was, or thousands of euros, whatever it was, or what is the German currency, I forgot. But again, people struggled a lot in that time because of similar things, printing a lot of money. Okay, so that was what happened in Great Depression. That is what happened in recent COVID also. Okay, there was a lot of printing of money, so that is why you must be hearing in news that the inflation rates are very high. Okay, because the prices have risen a lot, people have a lot of money currently. Okay, so the inflation rates are very high. Okay, I know it must have been a little bit confusing. So I'll clear it out again. And this is not all. Okay, I'll tell you more. We'll go to repo rates. Okay, I'll clear out a little. When government or central bank prints more money, okay, the currency value in international market decreases. Okay, and prices of goods also rise after some time. Okay, which gives rise to more inflation. Okay, so these are the repercussions of printing the money. Okay, but people print it because it is needed in economy in the things like COVID. Okay, in COVID scenarios, people did not have money, so to give to circulate more money, it was printed like this. Okay, now we'll come to see how government. Okay, it is not going. Ah, okay, something just happened. This is not moving properly. Let me reload it again. Okay, I guess my right click is not working properly. Anyway, now it's fine. So, how the governments print and make it reach to the people? Okay, this is what a concept called repo rate comes. Okay, okay. One scenario we saw printing of money. Okay, second scenario we'll see what is repo rate. Okay, so as we saw, there is a central bank, which is RBI in our case. Okay, which is the bank of banks. Okay, so suppose there is HDFC Bank. Okay, then there is SBI. Okay, let's take the example of these two banks. Okay, suppose in a COVID situation. Okay, many people, what happened, many people took out a lot of money because money was required. Okay, so many people took out a lot of money from their accounts. Okay, so what happened, these banks were running started running low in cash. Okay, cash decreases with this bank. Okay, so once cash decreases with the banks, it is a very difficult scenario for them to go let the business go on. Okay, cash decrease in both the banks. Okay, suppose, okay, now what they do, if we need money, we take loan from banks. Now banks need money because they have less cash. Now what they'll go? Now where they will go? They will go to their bank. Okay, RBI. They will say that please give us some money for X number of days, and we will pay you this much of interest, this much percentage of interest. Okay. Actually, bank do not say how much interest they pay. RBI asks for the interest, means RBI decide the interest rates. Okay, but it gives money to the banks. Okay, it gives money to the banks. Then banks take that money and give it to people. Okay, so this interest rate, which is decided by RBI, at which they are going to give interest to banks, it is known as repo rate. Okay, this is known as repo rate. Repo rate means interest that is given by RBI to the banks. Sorry, I'm saying it wrong. Repo rate means interest that is given by banks to the RBI in for the loan they are taking for a short period of money, a short period of time. Okay, this is called as repo rate. So how this plays out? Okay, suppose this repo rate is 7%. Okay, earlier it was 7%. So when banks will need money, they will tell RBI. Okay, they will, what they do is they give their securities. Okay, like they will have some, just like if we have to take some loan, we have to give some securities with the bank, so that later on when we pay back the loan, we get back the securities. Just in case of we default, the bank take those securities. Okay, similarly banks have to keep some this security with the RBI. Okay, what are those securities? There are treasury bills, there are bonds, and those kind of securities they keep as collateral with the banks. Okay, sorry, RBI. So and RBI gives 7% interest. Okay, so what will happen? It's currently 7% going on. Suppose tomorrow RBI decreases 7% rate of interest to 6% rate of interest. Okay, 6% rate of interest. So what will happen? Banks earlier they had to pay 7% rate of interest, but now they will have to pay 6% rate of interest. Okay, so the amount of loan got very cheap. Okay, now what happened? Banks are encouraged to take more loans. Okay, because since the loan is available at cheap. Okay, since banks are taking more loan, now banks will have more cash. They will be able to provide that loan further. Okay, they will be able to give that loan further. And since they are getting cheaper loans, they all and they have excessive cash, they will also want other people to take their loans so that they can earn money. So to encourage more people to take loans, suppose bank were charging 12% rate of interest earlier per person, now they will start charging 11% rate of interest per person. Okay, so what will happen, since people who need, people like us, okay, suppose we want to make a house and we want a home loan. Okay, we want to make a house and we want a home loan. Now we see that it is available at 11% interest instead of 12%. We will take that loan. Okay, we are more interested in taking that loan now. Okay, because it is available cheaply. Okay, so what similarly there are many people like us. Okay, there are many people like us. We are not the only ones. There are many people like us. There are businesses who want to take loans from bank to increase their further business. Okay, they want to scale up, or they want to do something more with their business. They want to take loans from the banks. Okay, there are businesses who also take loans. Okay, so since loan is more cheaply available, more and more loans is taken by people and banks. Okay, so what happened now? Now the interesting thing is, since RBI decreased the rate of interest, banks took more loans. They provided that to the economy. Now the entire economy has excessive cash. Okay, this is how more money is pumped into the economy. Okay, now entire economy has excessive cash. They can do more things with this. Okay, they can do more things with this money. Okay, and this is how money is transferred to the economy. More money is circulated into the economy so that people get empowered, businesses thrive more, and economy grows. Okay, this is what happens. This is the same thing, exact thing what happened in COVID. Okay, one is government printed a lot of money. That was one scenario. This is second scenario. Okay, where the repo rates were decreased from I don't know what percent to what percent. We'll see. This is a report. See, during May, okay. In general, what was happened? Repo rates are going in 6 to 7%, but during May 2020, they decreased to 4%. Okay, so this is exactly what happened in COVID times. Okay, the repo rate was decreased by the central banks. More money was given to bank. Some bank took more money. Those money was transferred to people. Okay, now this scenario can't go on for long. Okay, why this scenario doesn't go on for long? What will happen if if this excessive cash is always there in economy? So it will increase inflation a lot. Okay, inflation is how fast this prices are rising. Okay, since everyone has a lot of money, people will start charging more to for the services for this ingredients for the goods. Okay, people will start charging more. So what will happen? The prices will rise very fast. Okay, prices will rise very fast. This is why just after COVID times, you must have heard the news that inflation is rising very fast. Okay, you must have seen that after COVID, now the prices have increased a lot. Okay, it was because of this thing that there is a lot of money in the economy. Okay, so since now if inflation was 5% earlier, it will rise to 7 or 8%. Okay, now this is a problem. So fast rising of prices, it won't be a proper thing. Okay, many people won't be able to afford a lot of things after some time. So how this scenario is solved? Okay, how will this be solved? Okay, how this will be solved is the exact opposite of what happened here. Okay, now what happens? Now RBI saw there is so much of money in the economy that inflation is going a lot, means growing a lot. So what it will do? The repo rate that it decreased to 6%, it will now increase to 7%. Okay, 7 or 8%. 8% generally doesn't go. Suppose it increase to 8%. Okay, now what will happen? Banks will have to pay more interest in their loans. Okay, the loans that take from RBI. Okay, so since bank will have to pay more interest in their loans, they will they will start taking less loans. Okay, because they will have to pay more in the interest, they will start taking less loans. Okay, since bank will start taking less loans, there will be less cash with the bank. Okay, there will be less cash with the bank, and since there will be less cash with the bank, they will not be able to give more loans to the people. Okay, they will not be able to give more loans to people. So if some person comes, okay, if some person comes for loan, since there is not much, so they will start charging more for their loans. Okay, earlier they had, since here they had, oh, my mouse is not working properly. Anyway, since they had decreased this to 11%. Okay, now they will increase this to 13%. Okay, this guy will come and he or she will get loan at 13%. Now since the loan has increased, okay, not many people would want to take loan at this time. Okay, some people who want to build a house, they will wait for extra 2 3 years, because they will wait for loans to go down. Okay, because they won't be many people see 11% to 13% growing loan growing doesn't seem like a big jump. Okay, it seems like a small jump because we don't have that much money currently. Think about businesses. Okay, businesses who are taking loans of 100 crore, 200 crore. Even a 2% jump is like 2 3 crores for them. Okay, it is in crores. Okay, so they have to think properly before taking a loan. Okay, so since 2% jump in the loans, now businesses have to pay more. Okay, people who are taking money in lakhs. Okay, suppose someone took 1 crore for home loan. Okay, then now they have to pay 2 lakhs extra in their loans. Okay, so people won't be interested in taking loans now. Okay, businesses won't be interested in taking much loans now. So what they will have what will happen, even if people want the loans, they won't be able to take much now. Okay, so slowly everyone will be discouraged to take more loans. Okay, businesses also will be discouraged to take more loans. So what that will do, that will decrease the amount of cash in the economy. Okay, that will de- decrease the circulation of cash in the economy. And since the cash will be decreased, okay, since the circulation of cash will be less, people won't be having more money to pay for things. Okay, suppose at the suppose there is less cash with you. Okay, so if you see a higher good with higher price, okay, so you won't be want to pay more for it. Suppose you see something for 100, it is currently available at 120. Okay, and you have less money available now, so you won't be wanting to means pay more for that good. Okay, suppose you have 120 rupees, that costs 120 rupees, and you have only 100 rupees. You won't be able to buy it. Okay, or even if you have 120 rupees, you won't be paying all 120 rupees to them, because you may need that money later on. Okay, so there is a discouragement in the economy to buy more and more things. Okay, so what we see in the consequences, sometimes the price drops. Okay, of many things prices drop. Okay, since businesses don't have money, the manufacturing decreases. Okay, people won't be able to raise money so fast. Okay, people won't be able to charge raise their money or charge more money for their services or goods, because they know that if they suddenly raise the money, people won't be able to pay for it. Okay, so a slowdown in the economy comes. Okay, a slowdown comes in the economy. Okay, and sometimes also the inflation goes inverted. Okay, this and prices start dropping. Okay, this is a classic case of deflation. Okay, and earlier it was inflation, now what it is known as deflation. Okay, and these are the times when recessions come. Okay, the slowdown in the economy is called as recession. Okay, you must be seeing in news that recession is coming. Okay, why it is coming? Because now since there was a lot of money not printed, pumped into the economy by by this case. Okay, now RBI is starting to increase the interest rates. Okay, so money is getting sucked out of this economy. Okay, now banks do not have money more, and there is not much money. Flow of money is decreasing in the economy, and there is going to be a slowdown in the economy. Okay, now in the recent years you have seen a lot of price rising, and in the coming years you may see a very much slowdown in economy. Okay, not a long term, but at least a short term slowdown will be facing. Okay, so this is what about repo rates. Okay, repo. Okay, I forgot to say repo, why it is called repo rates. Okay, it is because repo is a full form of repurchase option. Okay, repurchase options. Okay, you'll be able to get it here in the. I'll just. Okay, somewhere it is there. I'll just put this in the description of the video. You'll be able to get it here. Repo means repurchase option, or repurchase agreement is also called. What it does is, when the banks kept the security. Okay, bank kept the security at RBI, they agreed that after the maturity period they will pay this much amount to the bank to get that security back. Okay, so it means bank was repurchasing that security. Okay, this is why it is known as repurchasing option. Okay, this is why it is known as repo. Similarly, again with a similar concept, we'll see reverse repo rate. Okay, reverse repo rates. Okay, what it does, okay, now again we'll have the same players here, RBI and banks. Let's take this time different banks. We'll take Kotak Bank. Okay, these are all Indian banks. We'll take Kotak Bank, we'll take ICICI Bank. Okay, let's take Axis Bank also. Fine. So now what will happen, since banks can take loans from RBI, okay, there is also a case like we deposit our money with banks, okay. In a similar way, banks also deposit their money with RBI, okay, and in deposit their money with RBI, and RBI gives them interest, okay. RBI gives them interest, okay, and the bank earn this interest from RBI, okay. Now, suppose this rate was 5%, okay, this interest rate was 5%, okay, this interest rate was 5%. Then a scenario like COVID came, okay, and banks are parking their money in with RBI, okay. Now what RBI will do? It will decrease this rate of 5% to 4%, okay, or 3%, okay, or 3%, okay. It decreased. So since bank were earning 5% rate of interest, and RBI is a government body, so banks know that they won't default with the interest, okay. So it was secure to park their money earlier, okay. But now since RBI is giving only 3% rate of interest, okay, banks will not be interested in depositing their money in RBI, okay. So what they will do? They will give they would want their money to go somewhere where they can get more rate of interest. So they will start giving cheaper loans to people like me or people like you or businesses, okay. Banks will also, what they will do, earlier if their interest rates were 13%, they will decrease it to, suppose, 10% they decrease, because they were not getting more money here, so they would want to get more money from us. So they would want to take more, so they would want more and more people or more and more businesses to take loans, okay. So they will decrease their loan rates at that time from 13 to 10%. Now people like us saw that cheaper loan is available, now it is available at 10%. So more businesses will come to take loans, more people like us will come to take loans, okay, and that loan will be given to people, okay. Now again, excessive currency is there in economy, excessive money is there in economy, so money circulation increases, okay. Same scenario that played here will start playing here. Money circulation increases. Now what will happen? The prices will start rising, okay. Okay, for a short time money circulation increases, everyone has more money now in the economy, so prices will start rising, okay. And again the inflation will come, okay. Inflation will come. N- Now RBI saw after 2 3 years the prices increased a lot because of this, okay, because of that inflation. So what it will do? It will again increase the rate of interest from 3% to 5%, okay, 5%. So banks saw that instead of 3% they are getting 5%, okay. So they will start depositing more money with RBI, okay. They will start depositing more money with RBI. And since they will have less money now to give loans, they will again increase their rate of interest to 13%. Again, people like me and businesses will want to take less loans. Okay. So there will be less, and now there will be a decrease in the money circulation in the economy. Okay. So prices either will drop or they will stagnate. Okay. Manufacturing will stagnate. Again, a state of deflation or recession kind of state will come. A slowdown in the economy will come. Okay. A slowdown in economy will come. Okay. So this is also a way in which RBI regulates the flow of money in the economy. And this way, earlier it was repo rates where banks were paying interest to RBI. Here RBI is paying interest because banks are keeping deposits. Okay. Since it is the opposite of that process, it is known as reverse repo rate. Okay. Reverse repo rate. Okay, this the reverse repo rate is this interest that is paid by RBI to banks for keep depositing their money. Okay, this is known as reverse repo rate. Now, what will happen is, since, you see, repo rates are always more than reverse repo rates. Okay, because it is same as our banks. Okay, the loan they are giving out that rate of interest will always be more than the deposits that we are making there. You must be seeing FD deposits are 5%, but the loans they're giving is 12%, 13%. Okay. Why? Because this is the difference that gives bank, this difference is what that give banks the money. They keep that difference of 7 to 6%. Okay, that is how the bank earn money. Okay. Similarly, RBI also, the interest that banks give to them, that rate is always more than the interest that RBI gives to banks. Okay, that is five, or some of it. Okay, I don't exactly know the percentage, but it will always be, well, means this interest that RBI gives will always be less than what it takes from the banks. Okay, because that is, in that way RBI will be able to earn the money. Okay, as a bank. Okay, so this is the entire scenario. Okay, this is how money is circulated in economy. The money that was printed by the central governments, sorry, central banks, how it was circulated in economy. It is circulated in economy using, means by increasing and decreasing repo rates. Okay. Okay, the inflation and deflation is a cycle that always goes on. Okay, always there will be recessions, always there will be inflations. Okay, because that is how the economy is balanced. Okay, the that is how central banks balance the money in, flow of money in economy. Okay, so whenever you see a recession coming, you don't have to worry much about it, because it is a part of the cycle. Okay, it is a part of the cycle. Something was there in my mind that I had to tell you. Okay, I forgot. Okay, if I remember, I'll tell you. Okay, so this is a part of the cycle. Now, one more thing. You will see, even if inflation and inflation happens in cycle, still, means I said it is cycle, but still you see, in an overall perspective, the prices of things are always rising. But like the price of oil, which was 50 rupees a liter earlier, now it is 100 rupees. Okay, now oil is a different scenario, because oil is natural gas. Of course, means it is going down. Means the quantity of oil is going down. But again, we'll take the example of biscuits. Okay, biscuits. Just some days ago, I saw that the biscuit that was available in my office canteen. Okay, for 10 rupees. 10 rupees, they were giving two cheese biscuits. Okay, cheese biscuits is available from some company. Okay, so some days ago I saw, means 1 year ago I ate this cheese biscuit. It was of a certain size, but now the size has decreased actually. Okay, now the size has decreased. Okay, it means the price is cost, the price has increased. Not only that, I saw another biscuits. Okay, like I like to eat biscuits. Okay, I like to eat biscuits with, sometimes I drink tea, so with teas I like to eat biscuit, and I like to eat biscuits in general. So there was some biscuit of some different company. Okay, I found that the number of biscuit has reduced in the packet. Okay, that they have reduced one number. Okay, so again, it means the price of biscuits are rising. Okay. Similarly, prices of goods, the rice that was available, means at a certain price earlier, now it is available at two, means 2 years ago, rice that was available at 55 or 58 rupees, now it is available at 60 rupees. Okay. So price of rice is rising, and overall, over 10 to 20 years, you must have seen what was available at 100 rupees earlier in your childhood. Now it costs around 600, 700, or even 1,000 rupees. Okay, that is because in an overall scenario, there is always inflation. Okay, and why there is always inflation? Because a, a certain percentage inflation, like 3 to 4%, or kind of 3 to 5%, that small amount of inflation is always good for economy. Okay, why it is good for economy? Because see, when you have a business, okay, when you have a business, you won't be charging the same amount of money for every day. Okay, since your expertise will increase with time. Okay, your quality of service will increase with time. Your quality of goods will increase with time. Okay, so you will be charging more and more money for your goods and services. Okay, and what will happen, that more money and that comes to you, you will be able to buy more goods. Okay, and when you will be able to buy more goods, that small business owner, that small vegetable seller, okay, from whom you bought more goods now. Means earlier you used to buy 1 kg rice. Now you will buy 1.5 kg rice. Okay, because you can afford more now. So that small seller who, who had less, who used to get suppose 10 rupees from you earlier, now he will be able to get 15 rupees for 1.5 kg of rice. So he has more money now. Since he has more money, he will be able to afford more things. And suppose you bought similar things from more people. Okay, suppose you bought more things from more people. Now all these people are able to afford more things. Okay, so they will buy more things. And since people have a little more money in general, they will be able to save more money in banks. Okay, and since banks will have more money in general, they will be able to give more loans. Okay, so in this way, a circulation of money increases. Okay, with the rising of prices, a circulation of money increases more. Okay, and it is a scenario that the more the circulation of money happens. Okay, the more the circulation of money happens in an economy, the more the economy develops. Okay, the more people would want to manufacture more goods, the more people would want to increase, eh, it means scale their businesses, the more people would want to work. Okay, see, if why would you in which company you would like to work more, where the salary is increasing more, where the salary is stagnant? Okay, you say people will want to work more in those companies where the salary is increasing for them. Okay, that company will be able to increase the salary, which is increasing business every year. Okay, okay. So similar, so this increases the quality of lifestyle. Okay, so what is happening, that business, since that business is now paying more salary, it is now charging more to other people, their customer. So a certain, okay, not too much a price rise, but a 3 to 4% of price rise every year na, 3 to 4%, it is considered as healthy for economy, because the entire economy will grow in that time, production will increase more, manufacturing will be done more. Okay, so this is why a 3 to 4% of inflation always increases, is always healthy for an economy. It is considered healthy for economy. Not exactly 3 to 4%. Something it is. I don't know. I'm not an economist, but it is in similar range. Okay. So this was all about repo rates and economics and all those things. Okay. Now, here repo rates and reverse repo rate, obviously we got. Now we'll see bonds. Okay. Of course, in previous video or previous class, I have already told about bonds. Okay, but again, I'll revise with a little bit more details now. Okay, I'll revise with a little bit more details. Okay, so let's cut the repo rates now. We'll come to bonds. Okay, bonds. Now again, we'll come back and come to the same thing. Suppose some corporate, okay, or government, we'll say corporate or government. Okay, now they want to raise money. Okay, so, which is a very suitable way. They will issue bonds. Okay. What are bonds? Bonds are nothing but a way of taking money from the public to them. Okay. A way of taking a loan from the public to these institutes. Okay. And what is there in a bond? It is a certificate. Okay, it says we are giving means this person is giving this much amount of money to this corporate or this government, and in the return, the government or the corporate will pay this much amount of interest, and it will be matured after this much years. Okay, this is what is written in a bond. Okay, so these bonds are issued by government and corporates, and these are then bought by people like you and me. In general, what is happened, these bonds are not much accessible to people like normal people. Okay, because in India, I don't know about other foreign countries. Okay, but in India, generally you have to buy bonds in lots. Okay, like you have to pay at least 1 lakh or 5 lakh rupees to buy a certain amount of bonds. Means you cannot take one bond. You have to take in lots like 50 or 100 bonds. You have to take. So you need at least 1 lakh, 5 lakh rupees or that much. That is why in general people in India don't buy much bonds. Okay, But we'll see how people in India can still invest in bonds. Okay, so governments took the bond from people and they are paying interest. Okay, either they will pay interest at a regular interval like quarterly or yearly, or they will pay a certain sum of money entirely at the end of the maturity period. Okay, generally what happens, the government bonds are considered more secure because people have this notion that government will never default because government obviously has some responsibility to the citizens. Okay, corporate bonds however are a little riskier because the company can go bankrupt, and once it goes bankrupt, people won't be able to get their money back. Okay, this is why in many scenarios you will see the interest rates of corporate bonds are higher than the interest rate of government bonds. Okay, because these are considered a little more riskier, but since corporates want to take money from people, they will give them more interest so that people will be interested in taking their bonds. Okay, now what happens, like there is a stock market, similarly there is a bond market also. Okay, and this thing is not accessible much to Indians. Okay, people don't have much access to this bond market. That is why even I don't know much about this bond market. Okay, so I won't be able to tell a lot of things here, but I will just give you a brief scenario that in bond markets also bonds are sold, and bonds are means these certificates. Okay, this kind of certificate, these are sold and bought. Okay, in bond markets. Okay, now how the price of a bond is decided, suppose there is a 10 there is a 10-year period of a bond. Okay, a government bond that will mature in 10 years. Okay, suppose it is 100 rupees. Okay, and it is paying 7% rate of interest. Okay, now what will happen, we saw the RBI example na. Now RBI decides to decrease its repo rates from 7% to 6%. Okay, 6%. Now what will happen? These bond issued by government, na, they will also go down in the rate of in their interest. Okay, they will also come. The new bonds issued by government. This is an old bond. Okay, this suppose this is an old bond that will mature after 10 years. Now government issue new bonds. Okay, government issue new bonds. Okay, since repo rates have been decreased. Okay, so governments or corporates will also be encouraged to give less, means less interest. Okay, because the entire money will be having this, means since bank will have less, will be giving less interest in loans. Okay, bank will be giving less deposits, since similarly governments will also start giving less interest in the bonds. Okay, so what will happen, a new bond has come with 6% rate of interest. Okay, now what happens, now this old bond, okay, after 10 years what will happen, government will pay the sum of money to that person who will have this certificate. Okay, who will have this certificate, who will be able to show this certificate to government. Okay, so government will pay the money. So suppose this new bond is issued in the market. Okay, now it is a new certificate, it also has a 10 years period. Okay, 10 years period. Now what will happen, the people who have bought this bond, okay, people who have bought this bond, they would want to keep this bond. Okay, because this has less rate of interest and this has more rate of interest. So after 10 years they know this people who will have this bond, they will get more money than this. Okay, so they would want to have this bond. So what will happen in the bond market, since demand for this bond increases because this is paying more rate of interest, the price of this bond goes from 100 to 110. Okay, the price of this bond increases from 100 to 110, and the price of this bond that is available in market decreases from 100 to 90, suppose 90. Okay, so this is how bond market works. Okay, I don't have a lot of idea about it, but I had this basic idea, so I thought of giving it to you, means telling it to you. This is how bond markets work. Okay, we saw a concept here. Okay, this is what, like, the RBI increased the rate of interest, so government also decreased the rate of interest. So what happened there? Okay, what happened there? Let us see again. Suppose repo rates. Okay, we'll again come back to repo rates. This concept, because this slipped out of my mind earlier. Okay, Repo rates. RBI decreased from 7% to 6%. Okay, 6%. Now what will happen? Uh, okay, so banks will have to pay less rate of interest. Okay, so they want more people to take more loans. Okay, so whatever loan was 13% earlier, they decreased to 11%. But banks want to earn profit. Okay, earn profit. So suppose they were giving 4% in savings account earlier and 6% in FD. Okay, now since they have decreased the amount of their loans. Okay, so they earlier what they are earning earlier, they were earning 9% in this savings, and they were earning this, how much it is, 7% in FD. Okay, now they will start earning 7% in this savings and 5% in FD. Okay, so due to, so they would also want to maintain their profits. Okay, because it will not, if their profit decreases, they will not be able to scale their business. Okay, so to maintain their profits, they will now start giving less interest. Okay, they will decrease their interest to 3% in savings and 5% in FD, or 2% in savings and 4% in FD, like it is happening naturally nowadays. Okay, so they will decrease their rate of interest. Okay, and this scenario plays out everywhere. Okay, in a similar scenario, the governments will also give, the government bonds will also decrease in the rate of interest. Okay, everywhere in the economy, the rate of interest decreases. Okay, not only in banks, everywhere. Okay, and the reverse happens. Okay, when the repo rates again increase to 7%, banks will increase their loans to this 13%, and similarly, to attract more and more people to deposit money in banks, they will increase the rate of interest here. Okay, this scenario always plays, and in the same similar way, the government bonds rate of interest will also increase. Okay, this scenario always plays out. Okay, this is what happens in the economy. Okay, the bonds, we saw the bonds. Ah, welcome to the last thing in of this session. Okay, the last topic of this session. You must, this is an interesting thing. Okay, you must have seen FD rates are higher than savings account rate, savings rate. Okay, not only FDs. Okay, not only FDs. FD rates are higher than savings rate. Okay, currently it is 4 to 5%. Okay, 4 to 5% in India. Savings account, it is, they give 3 to 4% in India. I'm talking about general banks. Okay, 3 to 4% or 2 to 3%, not 3 to 4%. 4%, they're giving 2 to 3%. Okay, at present. Okay, so why these FD rates are higher in India? Sorry, in with banks as compared to savings account. Okay, we'll see this. Okay, see what happens. FD creates more certainty for banks. Okay, we'll tell you. Suppose you have a savings account. Suppose you have a savings account and someone has a current account. Okay, so what happens here, in savings accounts and current accounts, you can take out money at any time you want. Okay, in savings account you have to maintain a low level of money, but in current account you don't have to maintain the money. Okay, so you can take out money anytime you want. Okay, so this creates an uncertainty for the bank. Okay, so since you can take out money anytime you want, it creates uncertainty for bank, because if in the time of need, banks will have less cash. Okay, so what will happen, this is the reason they give less interest. Okay, because they don't want people to put more money in savings or current accounts. Okay, now in FDs what happens, however, in FD no one takes out money every day. Okay, every single day, no one does transaction with FD, and some FDs have a lock-in period of this much years also. Okay, so in that case, what happens? A certainty is maintained with bank. Okay, bank can take that much money. Okay, bank can take that much money and do their business with that money. So certainty is maintained with the bank. So banks would obviously want people to have their money with, means they would obviously want to keep their money keep people's money for longer time. Okay, so they would increase their interest rate in FD so that people would park their money here more. Okay, they would keep their money here more, and banks will always have a cash flow going. Okay, now let this is from the bank's perspective. Let us see from the person's perspective. Okay, the person who is putting money in savings and FDs. Okay, suppose it is a saving account. Okay, you have a savings account which has 3,000 rupees. Okay, this is me, poor guy. I have 3,000 rupees only. Okay, so I can take however money I want. Okay, means I can take whenever I want. I can deposit more whenever I want. Okay, so since I can take out my money whenever I want, there is no risk for me in the savings account. Okay, there is no risk for the default. Okay, because suppose 2 years later bank goes down. Okay, the bank goes bankrupt. Okay, so in that case, what will happen? Before that, I can always take out my money. Okay, there is not much risk. Suppose let us see it in this way: you gave some money, you gave some 2,000 rupees to a friend. Okay, though. Okay, now there are some good friends who always return the money. Okay, so now there are some good friends who always return the 2,000 rupees, and some very good friends will also give a 200 rupees interest to you. Okay, so 10%. Suppose that is not. Let's give take 50% rate of interest they gave. 50% rupees they gave you in interest. Some good people are there who actually return your money on time. Okay, but again there are some friends. We all have all those friends. Okay, who do not return that money, or if they will return after a very long time. Okay, so what will happen? You would not want to give your money to those kind of people. Okay, so what people do is this savings account and FD accounts, consider them as those kind of friends. Okay, so saving account is that friend from which where people are, if they are giving 3,000 rupee to them, they can get their money back whenever they want, whenever they want. Okay, that is why people would like to give them this much of money with less rate of interest. Even 2% rate of interest is good because people are getting back that money whenever they want. But this FD friend is like this friend, this person who will give the money late. Okay, so this money is a little bit riskier because people will not be having money whenever they need. So if they are anyway they have to give the money to this friend, they will give it at a higher rate of interest at around 5%. Okay, so this is why generally FD rates are considered higher than savings account rates. Okay, this is why they are higher because FD is that bad friend who will give you money later on, but savings are those good friends who will give you money at a proper time and with interest also. Those very good friends. Okay, so I hope this analogy worked for you. There are some articles. Okay, one more thing I would like to say. I forgot about this thing that I was reading. This is just a small bonus thing. Okay, treasury bills. You must have heard about treasury bills. Okay, what are treasury bills? Okay, these are actually kind of bonds only. Okay, treasury bills are known as. This is just a definition I'm explaining. Okay, it is not. It doesn't have any much concept here, but the bonds that are issued by government for suppose uh, 1 year. Okay, 1 year or 6 months. Okay, these bonds that we the bonds that we saw earlier. Okay, those kind of bonds are issued by governments. Generally, they are of every kind. Okay, there are 30, even there are 30 years of bonds that governments issue. Okay, 30 years, 10 years of bonds, 5 years of bonds, 2 years, things like that. Okay, and government issue short term bonds also. Okay, short term bonds also. So those bonds which are available for less means whose maturity period are less than 1 year, they are generally considered as treasury bills. Okay, they are not called bonds, they are called as treasury bills. Okay, and those those which are more than 1 year of course they are called bonds. Okay, now see this savings and FD interest rate that we saw now, that same thing plays out here also. The treasury bills or the short term bonds will always give you less rate of interest. Okay, they will give always give 5 to 6% rate of interest. Okay, and the long term government bonds like 10-year 30-year bonds. Okay, 10-year and 30-year bonds, these bonds will always have the highest interest rate, like 7%, 7.5%. They will have like this, okay? 7.5%. They will always have higher rate of interest. Why? Because the time horizon is more. So it is a bigger risk for the individual to give bond to 10 years, 30 years, because the time horizon is more. And since they're short-term bonds or treasury bills, they will people will get back the money in 3 months, 6 months, or 1 year. So the time horizon is less. So the risk for the individual is decreasing here. Okay. So this is why the interest rate will be less here, 5 to 6% or things like that, similar like that. Okay. So this is the macroeconomic concept that we wanted to know, because these things affect many things. Okay, like in future we'll be seeing the in the future classes or in the future sessions, when we'll see the stock price stock means when we'll be analyzing the stocks, we'll see if the borrowing increases. So for some time the business got gets sluggish. Okay, the rate of increase in profits also decreases and everything. Okay, these things will play out later on. Okay, that is why I wanted to teach these concepts currently. Okay, these are some important things that we need to keep in mind if we are in the investing world. Okay, otherwise we will be just shooting arrows in the blind, means in the dark. Okay, will not be able to know a lot of things. Okay, now we are open to questions. If anyone has any questions, feel free to ask. Let me just bring this to here. I'll just okay. So anyone has any questions? Shiva, Jyoti, Ashirwad. Jyoti doesn't have any question. Shiva, Ashirwad, do you have any question? One thing I'd like to say, Shiva doesn't have. These are actually very. This must be a little confusing concept. Okay, the reverse rate and sorry, repo rates and reverse repo rates. They must be a little confusing because uh, these are like that. These are very similar things. It is very easy to get confused with the names. Okay, so whenever you get confused, I'll give description to. I'll give a. I'll put this post link in the description. Okay, you can come back and check this post. Okay, about repo rates and reverse repo rate. We have explained it very well in this post. Okay, and if you like it more, you can. Of course, you can follow our handle, Instagram handle, Finnet. Okay, and if you really liked this video, please consider going and liking this post and following us here. And of course, you can subscribe to our channel. Okay. So I don't see any questions popping up currently. So I think we'll be ending the session today at this point. Okay. So thank you guys for joining. Thank you for those who are watching the video also. Thanks. Thank you very much. It means a lot when you join, you watch these videos. It really helps me a lot. It really encourages me to make more videos or take more sessions. Okay, next time we'll be next class will be either seeing more about mutual funds, or we'll start with the stocks. We'll see which one is most suitable. Most probably we'll be looking more on mutual funds. Okay, on how to select them and everything. Okay, so with this we are ending this session. Okay, thank you guys for joining. I hope you have a good time. You had a good time watching this video, and I hope you'll have a good time after this. Okay. Thank you very much.